Good morning. You're watching Market Cafe on ET Now with me, Snehi Shah, and along with me is Lisa Fernandez. Now, this is a show where we take you through all the important global cues that you need to be tracking, all the major global stories happening, all the updates that we're getting from the global world in terms of equity, the handover that we get from the global markets, as well as we focus on domestic sectors and tell you all the stocks that you should be keeping on your radar this morning, as well as the stocks that the brokerages are spotting this morning. With that, Lisa, let's start the show then. And why don't you tell us what the global handover looks like on a monthly basis? Now, July has ended on a positive note for quite a lot of indices worldwide. So, take us through a list of what the global handover looks like.
So, right, Snehi, the July month has ended and all the indices, they have posted good gains for July. Dow, that was around 3%, and even S&P, that was up around 3%. But what saw big gains was the Nasdaq. It posted its fifth straight winning month in July, and we saw positive gains in July because of many factors. Actually, the strong labor market that came in, and even the strong GDP data, the cooling inflation, as well as Fed indicating that it will pause rate hikes going forward. And even the earnings picture, that also looks rosy, with 80% of companies, they posted an earnings beat. So that raises hopes of avoiding a recession. Well, on the earnings, we have pharma companies, Merck as well as Pfizer, that will be reporting their earnings, as well as HSBC, Nomura, Uber, Starbucks, as they will be reporting their earnings. On the economic front, we have the job openings data from June, as well as the July PMI index that is slated for release. And economists, they are expecting that the US economy will be adding 2 lakh jobs in July. Now, shifting focus on the European market, they also witnessed higher in the indices, and that was because of a dip in the Eurozone inflation. The headline inflation in Eurozone, that fell to 5.3% in July, falling from 5.5% in June. Now, the investors are looking ahead to a key policy decision from the Bank of England on Thursday, and we know that the inflation is a very important gauge for the Bank of England policy decision making. The DAX, that was down 0.14%, Stock 600, that was up around 12%. So that was on the US as well as the European market. But what's happening on the crude check, Snehi? It's at a multi-month high, around 3 months.
Is also looking very exciting. It's a very buzzing space, and because oil has also hit multi-month highs. Now, oil prices have rallied to a fresh 3-month high on Monday and recorded their steepest monthly gains since January of 2022, supported by signs of tightening global supply as well as a rising demand through the rest of this year. Now, the more actively traded October Brent crude futures rose almost $1 to settle at that 85.4 dollar barrel mark. And the September Brent contract, which expired at the settlement on Monday, rose almost 0.7% to close at that $85.5 per barrel mark. Now, the WTI crude futures also rallied $1.2, or like that was a 1.5% uptick coming in over there also. Closed somewhere just north of that $81 per barrel mark. And both Brent and WTI have hit their highest since late April for a third consecutive session on Monday, after notching their 5th straight weekly gains on Friday. So lots of buzz and lots of action and uptick coming in the oil space as well. And also Saudi Arabia is expected to extend a voluntary oil output cut of 1 million barrels per day for another month, to include September as well. Now remember, the oil production in Saudi as well as the OPEC oil production have been curved in the last 1 month as well. So this also indicates that demand is going to remain tight, and with supply being limited, it's expected that oil prices will continue to inch up. But let's see how that pans out for oil then, Lisa.
As well as events to watch out for today will be on the domestic front. We have auto sales, India fiscal deficit, as well as the PMI data that we have to keep a watch on. Well, on the earnings, Cholamandalam Investments, Escorts, Godrej Agrovet, PABR, Thermax, Welspun Enterprises, Metro Brands, Adani Total Gas, Anupam Rasayan, they will be reporting their earnings. On the corporate action front, Piramal Pharma, it's the last day to buy the rights issue. So that's on, we have to keep a watch on for the investors.
All right, let's move to some global stories we're tracking for you this morning then. And Federal Reserve Bank of Chicago President Austin Goolsbee said data showing slower US inflation is fabulous news, but he hasn't yet decided on whether to support pausing interest rate increases at the next policy meeting. The Fed's goal, he said, is to stick on the golden path and get inflation down without causing a recession. In addition, he also said that he hasn't made up his mind about whether to raise interest or stop hiking at the September meet.
And on some earnings, Amazon will be reporting their earnings, and ahead of the key earnings, the investors will be closely watching the updates on Amazon's cloud business as well as the revenue, and they signal towards the consumer health as well as inflation, which continues to impact the spends. Peers such as Microsoft as well as Google, they both reported slowing growth in their cloud business in the quarter gone by.
And ExxonMobil, in a move to expand beyond fossil fuels, is in talks with Tesla, Ford and some other automakers to supply lithium for electric vehicle batteries. According to Bloomberg Law, the oil major is also holding discussions with Samsung and SK on company. The talks are at an early stage, and Exxon has not yet laid out its plans for diversifying into lithium operations.
And in some more important news we are tracking this morning, China has announced export controls on some drone-related equipments amid efforts to safeguard the national security as well as their interest. And this announcement that comes amidst the escalating tension with the United States over technology access. Well, the said restriction will take effect on September 1st.
And Tiger Global has now exited Flipkart with mega returns, selling its equity in the e-commerce company to Walmart. My colleague Sumita has more details on this. Sumita?
New York headquartered investment firm Tiger Global informed its limited partners last week that it has completed its exit from Flipkart, fetching a total of $3.5 billion in total gains over the past few years of a phased sell-off. Sources have informed TT. In fact, Walmart has paid $1.4 billion to buy out that investment in the e-commerce firm, after which its valuation has soared to nearly $38 billion. And Walmart now holds a whopping 72% stake in Flipkart. Now, speaking of Tiger Global, sources have also told ET that this is amongst the most it has generated from a single company globally, and also the highest profit it has managed from an Indian internet firm. Tiger's overall gains from Flipkart will rank amongst the highest cash exits for the fund, with its most successful investment being in Chinese e-commerce giant JD.com, where it pulled out $5 billion after pumping in nearly $200 million. Seeing the potential of e-commerce in China, Tiger decided in 2009 to pump $9 million into Flipkart at a valuation of $42 million when the startup was just an online bookseller. But most of the $1.2 billion deployed by Tiger in Flipkart came after 2015, when the company hit a rough patch and was unable to shore up external funds. But the question is, why did Tiger Global decide to sell its stake? Well, coming off a turbulent 2022 due to crash in technology valuations across public and private markets, Tiger has been selling big portions of its shares in portfolio companies. In India, it's exited listed logistics company Delivery and online insurance marketplace PB Fintech, while partially selling its stakes in food delivery major Zomato. However, the investment firm does remain bullish on India, particularly on India's internet story.
Well, that was Tiger Global exiting Flipkart. But with that, let's slip into a short break. More news and updates on the other side of the break, so stay tuned. Welcome back to this edition of Market Cafe, and now shifting focus to the earnings. Auto major Maruti has delivered a largely inline set of numbers for the quarter gone by. The top line and the profits that were reported that were in line with the street estimates, but the margin and EBITDA, they were below estimates. So let's go across to my colleague Shrishti to make sense and break down the numbers for us. Over to you, Shrishti.
Well, yes, not a great set by Maruti Suzuki this time around, and especially a disappointment coming in on the EBITDA as well as the margin figure. Though, like you rightly said, that the revenue and the profit that has seen a growth on a YOY basis, but that was in line to the street estimates. The disappointment was the margin figure. The street was expecting a margin to be over 10%, 9.2% is what the company clocked in. But they also highlight that this has been impacted by a one-off, where the employee benefit expense has inched up 26% on a YOY basis, and 80 basis point hit is what the company has faced on the back of that. And other than that, the shortage of semiconductor continues to impact, where the company lost 28,000 vehicles not produced in Q1, and no significant improvement in the pending order book, which stands at 3.55 lakhs. That was about the number. But other than that, a very major announcement coming in from the company, where Maruti Suzuki board approves the acquiring shares of Suzuki Motor Gujarat from Suzuki Motor Corporation. Because earlier, if you remember, back in 2014-15, this agreement was come into place, where Suzuki Motor Corporation put up a plant in Gujarat where they were putting the money, and this whole setup was on the back of contract manufacturing. What Maruti Suzuki is doing now is that they're exercising their rights to get these shares from Suzuki Motor Corporation, and then the transaction is expected to complete by 31st March of 2024. Now, what the analysts are believing on this is that all production related activities will come under Maruti Suzuki. That's a good part. The margins are expected to improve in the long run because this whole contract manufacturing setup won't be there, but there will not be any impact on the profit is what they are highlighting. But a key to note is that the cash on books of Maruti Suzuki will go out, because all this agreement has come into place because Maruti Suzuki wanted to focus on getting their balance sheet to be asset light. But now the cash on the books will go to Suzuki Motor Corporation, and that is not something that is great to see in the short term, but in the long term, definitely a positive move by the company. So those were the results highlights of Maruti Suzuki.
All right, thank you, Shrishti, for breaking down Maruti Suzuki's numbers for us. But let's move on then. And food inflation dampened overall enthusiasm. That is the exclusive word coming in from Nestle CMD Suresh Narayanan. Talking to ET Now's managing editor Nikunj Dalmia, Narayanan said inflation situation is better than last year, but not fully contained. He also spoke about premiumization being an important focal point for brands. Listen in to this exclusive interaction he had with Nikunj Dalmia.
What is concerning today, or what has been of concern to us in the recent past, has been food inflation. I think that is a factor that in some sense has dampened the overall kind of enthusiasm as we go forward. Now that is somewhat getting under control as we see it going forward. Again, we still have a few imponderables, but I hope, like an internal optimist that I am, that we come out of this sooner than later, that the volume prospects and the growth prospects will be much better for this company. Bharat is discovering the brands of Nestle. So earlier we were, as you would recall, largely a metro and a mega city company. Today, we are into the lower town classes, TC1s, TC2 to 6, and rural India, and enjoy about 20% of sales coming out of these rural markets. And in the last 8 to 10 quarters continuously, we have enjoyed double-digit growth across all these geographies. So Bharat is discovering the Nestle brands. There is secular growth. The last 5 quarters of the company has had double-digit growth across each and every category of the company.
40% of your total business, sir, is in milk products and nutrition. There is an unprecedented milk inflation. What is the impact of that? And second, at a time when in general the growth rate in India is plateauing, it is certainly not expanding like what we saw, could that be a mega trend which could impact your future business?
Look, I think overall economic growth, you see, one of the things typically in very mature categories with very high penetration levels and where the number of incremental households that you can get for your brand is relatively limited, you correlate yourself with GDP growth. So you say, if GDP growth is 6%, my growth should be 1.5 times GDP growth, which is 9%. I think in the case of Nestle, I have still not allowed that thinking to get into the context of the company. So I do not index myself on GDP growth, whether it's 6% or 7% or 8%. For me, the reality is that the penetration of my brands is still relatively low. If the brands have got equity, promise, and something to offer competitively, there is an opportunity that I have to access the consumer. How well I do it in terms of brands, in terms of equity, in terms of the 4 Ps, and in terms of access models, if I'm able to get that successfully, I think that is the track record of the company. So therefore, I am not for the moment getting myself under the weather, looking at whether the IMF or the World Bank or whichever agency predicts a 6% or 7% or an 8% growth, because I still have got headroom for growth. And once I become in the category of very mature brands in this country, which enjoy, and maturity for me is a 90% plus penetration, that is when I would start to do the econometric modeling of GDP growth versus the growth of the company.
And now shifting focus from one FMCG major to another, Marico's revenue growth will start to return in second half. That's the word coming in from Marico's MD as well as the CEO, Saugata Gupta. He also says that the company is poised for double-digit growth in the international business. So quite an upbeat commentary coming in from the management. So listen in to this exclusive interaction with Marico's MD.
We had a significant deflation. As you know, last year, this was the quarter immediately after the Ukraine war had started, there was significant inflation. And therefore, if I look at a point to point, especially in Saffola, there was a 30% price reduction, which we took YOY versus last year when the pricing was at its peak. So I think this entire deflation factor will keep on gradually reducing, and the anniversarization will happen. In addition to that, we have also got impacted, as you know, that there has been currency depreciation in some of our markets, in international markets, which again started sometime in the second half. So the anniversarization of that also will start and therefore neutralize that deflation factor that's happening. So the way we see it is that you will start getting revenue growth sometime, definitely in the second half, where the deflation gradually will move into maybe flat to slight inflation as we get into the second half of the year. Now, coming to Parachute, as we had indicated, it's a one-off, and we expect the reason it has been because of the fact that we are smoothing all the inputs across the year. Historically, we have had a far bigger Q1. We are trying to ensure that we try to have our secondary sales and primary sales in line with our overall offtake trends, and therefore the peak and troughs in trade inputs which we used to give, we have been gradually smoothing it out. That is good for working capital, that is good for long-term sales spend effectiveness, and therefore Parachute growth numbers are going to improve as we move towards Q2 to Q4.
Saugata, you're confident of achieving over 150 basis point margin improvement in the full year. I want to understand where exactly is this confidence coming from?
Combination of three things. One is obviously the input costs are far lower than what it was last year. We continue to have an aggressive cost management program in the organization. Our D2C brands compared to the other brands in the same space have far lower burn rates. Like, for example, whether it's Plix or Beardo compared to similar brands which are in the same space, our burn rates are far lower. As you know, that we go and select brands which I believe and the founders believe in sustainable, profitable growth. Also the fact that one of the things we have been
All right, that's the word coming in from the top boss at Marico on where he sees growth headed for the company going ahead. But despite parliamentary approval and consent of industries, new labour codes are unlikely to be implemented soon. Now, ET now has learned from sources that new codes will be left for the new government to implement, as many states and labour unions still have apprehensions on few provisions of the bill. My colleague Prakash Priyadarshi is joining in with more details on this. Take it away, Prakash.
So the government is likely to postpone implementation of new labour law reforms yet again. Sources are informing that the implementation of new labour codes may be deferred till a general election next year. So it's been more than 2 years since Parliament has approved these codes, but the government has not been able to implement it. We also given to understand that some states have not finalized rules on these codes and have apprehension on some of the provisions as well. Since government is trying to build consensus before moving ahead, therefore it wants all stakeholders to come on board. When it comes to labour unions, we are given to understand that labour unions have approached government to make necessary amendments in the provision that is with regard to employee threshold limit for winding up of industry or unit. As you are aware that government has increased employee threshold limit from existing 100 to 300 through industrial relation code, and for that government permission is not required to shut down industry, and it is one of the big bone of contention between government and labour unions. Moving ahead, when it comes to industry, we are given to understand that the industry has given its consent to implement codes on wages. It had some apprehension on codes on wages, but the industry is now okay with the current provision, which says that allowances should be capped at 50% of the overall salary. If you look at the data, so far 26 states and union territories have framed rules on OSH code, 28 states and UTs have framed rules on industrial code, 30 on codes on wages, and 28 states have framed rules on social security code so far.
All right, Prakash, thanks for those details on what's happening with the new labour code. But with that, let's quickly slip into a short break. We go stock specific as we come back on the other side. Hi there, welcome back and thanks for staying tuned to Market Cafe. Now it's all about autos this week as auto dispatch figures will start trickling in. Now the PV segment is expected to see tepid demand while commercial vehicles or the CVs could see seasonal weakness. Shrishti tells us what to expect from today's auto sales numbers. Shrishti, break it down for us.
Well, yes, from the July sales auto data, we are not expecting much because this time the monsoon will play the key role in terms of the sales. Before coming to the numbers, let's have the segment-wise expectation that we have. On your screen, you will see that the passenger car segment, the small car discounts is inching up further. It's expected to be a tepid demand season this time around. For the commercial vehicle segment, a seasonal weakness could be at play and the discounts are inching up too. So on a month-on-month basis, not a great set of expectation on that front too. From the two-wheeler segment, because this year, we have all the festive season pushed a little back. So for the month gone by, we are not expecting a good jump in terms of the rural sales and no particular push when it comes to the festive or to the marriage season. And lastly, from the tractor division, we are seeing a sharp correction. We are expected to see a sharp correction on a month-on-month basis due to the inventory build-up and also on the back of the monsoon season. So let's come to the numbers. Firstly, onto the passenger vehicle segment, Maruti Suzuki numbers, if you will see month-on-month, that could see an uptick of 16%, but that will be on the back of a low base. So once again, this particular month, the company is expected to bounce back to its original or rather the normal sales data. For M&M as well as Tata Motors, we are expecting a flattish kind of a growth in their passenger vehicle segment. Now let's talk about the commercial vehicle segment. Like I was mentioning, a seasonal weakness could be at play and the discounts are inching up too. So from the likes of Eicher Motors, VECV, Tata Motors as well as Ashok Leyland, we are expecting a decline of 3 to 7% on a month-on-month basis. So not much expectation on that particular front. Now it comes to the two-wheeler segment. An interesting play could be Hero MotoCorp because last month the sales were actually higher and this time on that high base we are expecting a sales jump of 8% on a month-on-month basis. But other than that, a bit of improvement movement in terms of the export sales data for Bajaj Auto as well as TVS Motors is also on cards. And for Bajaj Auto, TVS Motors and Eicher Motors Royal Enfield, on a sequential basis, we are expecting a flattish kind of a growth. And lastly, from the tractor division, a decline of 29 to 44% on a month-on-month basis is what we are expecting. And that will be on the back of the inventory buildup as well as monsoon at play. So these are the expectations from July auto sales data. So all eyes on that.
Well, another company that was in focus yesterday was Agrochem UPL that reported very weak set of numbers. All the parameters, they came below estimates, and important highlight was that even the management, they sharply cut their guidance for FY24. Post market hours, we also had a con call where the management said that Q2 will also see a similar kind of decline that they had seen in Q1 as well. And the volume decline, which was at around 10%, that is not expected to be impacted as much as Q1. And coming on to the capex, to $325 million that was guided, but now they have come down to $300 million. And they also said that they will be postponing capex. They might postpone capex going forward, and on the debt, they plan to reduce the debt going forward, but that will be through cash conservation. And the competition from China, that is also expected to be intense and going to rise in the near future. That was on the summary of all the con call, demand weakness that was pointed out. Recovery is expected to be in H2, and they are also taking some cost initiative measures, and the debt reduction will be on the back of cash conservation. But riding on this, even Jefferies, they came out with a note on UPL. They have cut the target price to 800 from 925 per share earlier, and they said that was on the back of disappointing quarter as well as pressure on the volume as well as the price. So they have cut their FY25-26 EPS by a whopping 9 to 10%, and they have maintained buy on the stock, as we know that UPL is trading on very inexpensive price to earning multiple. So that was on UPL con call. But also let's listen to what the management had to say on their Q1 earnings.
Looking ahead across the global crop protection business, we anticipate Q2 to remain weaker than last year due to continued channel destocking in Brazil specifically, and the global reset in prices in the post-patent segment. As previously mentioned, recovery is expected from Q3 onward through normalization of channel inventories and demand for herbicides and our new launches as key growth drivers. Further, we're undertaking stringent overhead reduction actions. These measures are expected to positively impact by around $100 million in the next 24 months, with at least 50% of that being realized this year in FY24. So while Q1 was a challenge, the strength of our supply chain assets and our overall strong grower economics, which is driving end-use demand, plus our proactive cost actions and new product revenue growth, we foresee EBITDA growth in the second half of this fiscal year.
Alright, let's shift focus to gas then, and Gujarat Gas will be in focus in today's trading session as Aramco has hiked propane prices to $470 per ton. Now these new prices will be effective from September, and this hike by Aramco will increase prices in the Morbi region. Now post this hike, Morbi propane prices are expected to be at 40 rupees per SCM from September, and the company is currently selling gas at a price of 38 rupees per SCM, so that's a hike of 2 rupees coming in there. And higher propane prices will act as a positive for Gujarat Gas, so keep an eye out on Gujarat Gas in today's trading session.
And now we also look at the stocks to watch out. We have Ansh here with us. Good morning, Ansh. He will take us through all the stocks that investors have to keep an eye on. So Ansh, take us to all the stocks that you have on your radar.
Sure. So SBI will be the first stock in focus for today's trading session, as they have issued infrastructure bond with a coupon rate of 7.54%, having a tenure of 15 years. RVNL will also be in focus as they have won an order worth Rs 322 crore. Now let's have a look over a few earnings. Sumitomo Chemical's revenue is down by 26% and the net profit has fallen by over 55%. For Petronet LNG, despite revenue falling by 18%, the net profit is up by 13%, and this is mainly because the expenses has come down by around 18%. KEI Industries revenue is up by 14% on a year-on-year basis. Also, the PAT margin in this quarter has improved to 6.8% as compared to 6.6% a year back. HG Infra has also shown some good numbers. Revenue is up by 22%. Net profit has jumped by over 37%, and the EBITDA margin has improved by 270 basis points. JBM Motors revenue is up by 9.4%, whereas the EBITDA is up by 38%. Also, the board of directors has approved raising a fund of around 500 crore. Lastly, Power Grid's revenue is up by merely 1.3%. However, the net profit has actually dropped because expenses has gone up by 3%.
All right, thanks Ansh for all those stocks to watch out for. We will certainly keep an eye out on all those stocks. But let's also look at the stocks that brokerages are keeping on their radar this morning. And my colleague Ankita is joining in with all those details. Ankita, I believe you have notes from Investec and JP Morgan coming in this morning. So tell us what stocks these brokerages are spotting this morning then.
That's correct. There are two notes from JP Morgan and a note from Investec. Now, first up, JP Morgan has, maintained a neutral call on GAIL with a target price of 115 rupees per share. Now, according to them, the transmission volumes have been strong, but there has been a miss on the EBITDA front. Now, this is the, another quarter of EBITDA miss for the petrochem. Now, the LPG segment has come in better than expected. The higher crude should also benefit this segment, but they continue to believe that the investors are not likely to re-rate the stock on strong commodity business earnings, and on the back of that, JP Morgan has maintained a neutral all on GAIL. Now, the next stock is Petronet LNG, and they have JP Morgan has maintained an overweight with a target price of 320 rupees per share. Now, according to them, the Q1 results have been ahead of the estimates, and the utilization at the Dahej facility has been operating at a good 98%. Now, the volatility of the commodity market is well behind us, is what JP Morgan feels, and currently the stock is trading at 10x FY25 PE multiple and with a dividend yield of 5%. And Petronet is a well-placed value play according to JP Morgan, and on the back of that, they are maintaining an overweight on the counter. And finally, we have Investec on PB Fintech. They have initiated a buy call with a target price of 1,000 rupees per share. And according to them, PB Fintech has an online dominance that is unparalleled. They are leveraging its full service model to drive business flywheel. PB Fintech also has a history of successful bets, and the profitability is rather understated for the company as of now, is what Investec feels. But the health insurance segment is going to be the biggest value driver. Now, the EBITDA margins should continue to improve as a share of the trail revenue gains, and the PAT will also continue to outpace the revenue growth for the next at least 10 years. And it is a strong brand. The leadership position is pretty strong, and the management is focused, and they do see a good profitability for the company. And on the back of that, they have initiated a buy call for PB Fintech, and those were the brokerage notes coming in this morning.
Well, thank you, Ankita, for taking us through all the stocks that are on the brokerage radar for today. So do keep an eye on these stocks. But let me take you across to the biggest market voices on ET Now through the week. Ramdev Agarwal, S. Naren, as well as Ajay Srivastava, they share their sectoral views. So listen in.
Banking, I would say. Still, banking is going full blast, but the P multiple is not very high if you look at it. So you have a good chance of making, wherever you have an insight about 20-25% kind of growth, there you can make decent money. In fact, market beating returns you can get there. Say like Bajaj Finance kind of a company, which are traditional lenders, but using the power of technology. Say even the broking, where it has become all digital. Actually, the purest possible digital businesses in India are the broking companies. Yes. You know, whether it is Zerodha, whether it is Angel One, in terms of execution, we have still got lot more. We are a lot more phygital, I would say.
We did some analysis over the last 10 years, and we found that banks are the only sector which did not get where valuations haven't gone up. Whereas if you look at most of the other sectors in India, what we found was over a 10-year period, valuations have gone up by 30 to 40%. That the price to earnings multiples of most of the other sectors in India have gone up by 30 to 40%.
I think the most overrated sector too is retailing, certainly by any chance. Retailing, fashion wear retailing, most overrated sector. General retailing, most overrated sector. You saw the Reliance results. You've seen Trent. You've seen, Avenue you just spoke about. Just see their performances versus what the market valuations are. What's the most underrated sectors? Paper, PE of less than 5, highly profitable, duopoly, literally, no competition, necessary of life, but still the PE is 5. such as market, fashion retailing gets P of 120, essential profitable business of paper gets a P of 5. That's market, my friend.
All right, let's also go across and listen in to Aman Chauhan of Abacus Asset Managers. He shares his top picks for what he thinks will turn into a market share in the future and also shares his tactical trade for the current market scenario. So listen in to what he had to say.
First, the mega trend could be one where we see a shift from unorganized to organized. So whichever sectors, whichever companies are facing unorganized competition, I expect a clear market share shift happening from unorganized to organized. It could be because of GST, it could be because of new policies by the government. So this can be a good mega trend where the organized sector will gain market share. We are positive on metals from here on, and that can be a tactical trade for the next few months. Expect dollar to softening, and that can help commodity prices, which in turn will get reflected in the stock moves also. We have not been a very big bull on the auto sector. We have some auto ancillary stocks in the portfolio, but nothing on autos directly because we feel Indian companies are not well prepared for the EV, and EV is still a very small component of some of the companies like Mahindra or Telco. That's the reason we don't have a big auto exposure, and I think we'll maintain that stance. I don't see myself getting into auto stocks anytime soon.
And with that, it's a goodbye from me and Snehi. So do look forward to our shows in the upcoming show.